Thanks for seeing me today. First Bank recommended that I see an accountant, but I'm not sure exactly why. I'm just trying to set up a line of credit so that I can stock up on inventory before the Christmas buying season. The bank is already asking for an income statement and a balance sheet for my business.
Okay, that's a pretty common request. I'm sure that I can help with that. Let's see what information you already have put together.
Yes, this came out of my accounting software. I take a lot of care to make sure that everything goes in properly. So I don't see why this list wouldn't be good for you.
Well, this looks like a great start. Let's see if I understand what you have here. You seem to have very high accounts receivable.
Oh yes, that's one of my strongest points. I really want to show the bank that. We have just received a $20,000 order, so I entered that right away as sales and accounts receivable. I want to keep track of every single transaction.
Okay, and have you already delivered on the inventory yet?
No, but we're on track to finish by the 15th, and then we'll be inspecting the shipment by the end of the month.
Okay, that's actually something that we're going to need to adjust. Did you decrease your inventory already?
No, it hasn't been shipped, so I haven't changed my inventory. Isn't that right?
Yes, it's good that your inventory matches the inventory at your business today. Now, I noticed something else about the assets you have listed. You have building, but no land. That's very unusual. Do you own your building?
Oh, yes, we've just closed on our headquarters. Of course, we own the land too. The $250,000 I recorded for both the building and the land.
Okay, that's what I thought. Well, we'll have to separate out the value of the building and the land because they're considered separate assets and they have different accounting treatments.
But I didn't pay a separate price for the land and the building. How would I know what to separate them to?
Most appraisers apply 20% of the total price to the land and 80% to the building. So we can follow that rule of thumb safely for a new standard purchase. I noticed that the income statement is missing two expenses that I would normally expect to see. There's no depreciation listed.
What's that?
Depreciation is an expense because all equipment and facilities, they have a limited life. And so as they're used, there's wear and tear, and the productivity of that asset goes down. Now, since you have just purchased the building, I wouldn't expect any depreciation yet. But I wonder about the equipment. When did you purchase the equipment?
At the beginning of the year.
Okay. And how long do you expect for it to last?
About 5 years.
Okay. So we'll decrease your income a little each year to allocate for the cost of the equipment over the 5 years that you'll be using it. That's depreciation expense. Now, the second item that I expect to see somewhere is tax expense.
But I haven't paid taxes yet.
Well, even though you haven't paid any taxes, taxes are due whenever you have a profitable business. So even though you won't be paying your taxes until March, you still need to record the amount that you currently owe on the profit that you have had so far.
But won't that confuse the tax office to get my payments ahead of time?
Well, you won't actually be paying the taxes in it early. You'll be recording the amount of tax each period so that when the tax year is over, the taxes associated with that year will be on your books already. If you want to record tax expense on your books, you'll have taxes associated with last year's income on your books for this year.
So how do I record taxes if they haven't even happened yet?
Let's estimate taxes as your pre-tax income multiplied by 15%. You should be getting enough credits and deductions to help you stay in a low marginal tax level, I think.
That's a lot of changes.
I can have my staff make these adjustments and to your accounting records and create an income statement and balance sheet for your bank. Here's the adjustments that we've identified. Adjust the sales and accounts receivable for the unfulfilled orders. Adjust the value of the building and add land to your records. Add depreciation on the equipment and add taxes owed on your pre-tax income. Can you stop back tomorrow morning and pick up the completed financial statements?
Sure. Thanks so much.
All right, you're welcome.